Hello students, welcome to another session of JMC vLearning. So continuing from the previous discussion of SLFRS 3, we continue our discussion on how we are supposed to prepare consolidated financials. So let's discuss SLFRS 10 today and then look at what are the topics that we will cover, and let's look at few examples on how we practically work out a consolidated set of financials. All right, so let's look at what we will cover up today. So the discussions would be based on consolidated financial statements, so we will cover up basic consolidation. That's where we will look at where one parent acquires one subsidiary. How do we prepare financial statements on this? The discussion relating to when an acquisition takes place. So if we put it on a timeline, if an acquisition took place on 1st January 2019 when P acquired S, what you do and how you account for on this date was discussed in SLFRS 3. That was a separate session. So how do you calculate the goodwill on the acquisition date? All that was discussed under SLFRS 3. Now what we are looking at is at each reporting period end, say in this example 31st December 2019, how do we prepare financials? We will prepare financials for each entity. Whenever a parent has a subsidiary, the parent has to prepare a set of financials referred to as the group financials. So how do we prepare this is the discussion we are trying to have today in the context of a simple group where one parent, one subsidiary exists. Then we need to discuss investments in associates, so that's where we will expand the group a little bit more, where we will have one parent owning a subsidiary. So the knowledge carried forward from this discussion, plus we will also look at if a parent has an associate, how do we prepare financial statements. So building on that, we will expand the group structure. We will look at complex groups, that's where we will have one parent, one subsidiary owning another subsidiary, or a mixed group structure where a subsidiary is made up by parent owning a certain percentage and a subsidiary owning another percentage. So when you have multiple companies in a group, how do we prepare financial statements is the other discussion we need to have. Continuing on this, we will look at whenever you have a multi-structured group, if you decide to dispose of a company or if you decide to acquire a new company, how do you deal with it? So the changes in a group, how do you account for? How do you account for a disposal gain here, or how do you account for an acquisition here is the other discussion that we will have. Then we will move on to look at foreign subsidiaries. That's when a parent who prepares financials in LKR, let's say has a subsidiary who prepares financials in LKR, that's the usual case. In addition to that, parent has a subsidiary who prepares financials in USD. So how do we prepare consolidated financials when you have an entity within the group who prepares financials in a different currency than the reporting currency? So we will look at that as well. And finally, the last discussion we will have would be on joint arrangements. That's when an investor has joint control over another organization. So how do we incorporate such an entity? How do we incorporate such an entity into the financials, into the group financials, is the final discussion we will have. So we have, before we start on this discussion, you need to have the basic knowledge of SLFRS 3. We have completed that session separately, so you need to go through that before you come to this session. So it's mandatory you go through this discussion that we had already. You need to be familiar with the examples, you need to be familiar with the concepts of goodwill calculations, all that, because that knowledge is carried forward in the discussion that we will have here. So with this, we will be covering up the entire gamut of how do you deal with consolidated financials, looking at all complications possible. And then eventually, at last, we will look at how is this tested at the exam. So exam focus, we will come up at the end. So we would have covered all the required theory parts, all the required base knowledge that we need to have, and then let's look at how is it tested at the exam and how you would approach an exam question and how do you summarize, gather all the knowledge that you have already and write an answer on an exam type question. And then let's run through a few past paper questions as well, right? So that's the plan on consolidated financial statement discussion. So we will cover it step by step. Now at each level, we will look at a lot of examples. So under basic consolidation, we will cover about 5 examples. Under investment in associates, we will cover about 3 examples. On complex groups, on this we will cover about 3 examples. And on disposals, we will cover about 4 examples. Foreign subsidiaries, we will cover about 3 examples. And joint arrangements, about 1 example, because that's pretty straightforward. And then let's look at few exam questions. Right. Now, at the strategic level, what the examiner is looking for in a student is the ability of the student to apply the knowledge the student has on consolidated financials to a case study. So it might not necessarily be preparing the consolidated financials per se, but the knowledge on how you prepare consolidated financials will be tested through a case study looking at implications of a particular transaction taking place within a group. So say as an example, the examiner might say, all right, an entity which owns P, which owns S, is now deciding to acquire a subsidiary, or a group which has P, S and T is disposing T. The examiner might not necessarily ask you to prepare a consolidated balance sheet to show how it is reflected. Rather, the examiner might say, okay, what's the disposal gain? So you need to know how every number gets linked up, how do you deal with goodwill, all that in calculating the disposal gain or loss. So it's very important we cover the base understanding first, looking at it in the context of preparing financials. So we link up all the adjustments on how it will get reflected in the financials. Then let's look at when you have independent case studies, looking at particular situations, how do you deal with it. So we will cover up these examples through preparing consolidated balance sheets. We will establish the knowledge through that, and then let's move on to case study type questions to check our knowledge and see whether we can apply them. Again, at strategic level, this is a knowledge carry forward from the previous level is required. So this part, that is basic consolidation and investment in associates, would have been covered in your previous level. However, we will cover it up here as well, but in a much more brief form. It's a refresher of your previous knowledge, and where this level kicks in is from complex group onwards, which is a new area at this level only. So your previous level knowledge should give you a basic understanding of basic consolidation and investment in associates. We will refresh it quickly and then we will move on to complicated areas. So that's a plan on how we deal with consolidated financials, and the plan for the discussion in today's session would be on covering up basic consolidation and investment in associates within 8 examples. All right. So let's start with SLFRS 10, covering up the basic requirements of SLFRS 10, and then let's move on to examples on preparing consolidated statement of financial position. So what I've done here is I've summarized the requirement of SLFRS 10. So let's run through each topic one by one, looking at an explanation on each of it, and then let's get into consolidated financials. So the main things that we need to discuss is, what's the purpose of SLFRS 10? The purpose of SLFRS 10 is to lay out the requirement relating to preparing consolidated financial statements, and then how do you prepare it. Now, what the primary criteria is on SLFRS 10 is whenever an entity controls another entity. So the most basic example is whenever an entity owns more than or equal to 51% in another company. In the absence of anything else to the contrary, whenever you own majority shares, it's presumed that you have control over the entity. So the entity that controls the other one is called a parent, and the entity that is being controlled will be referred to as a subsidiary. Right. So whenever an entity controls another entity, it is supposed to prepare consolidated financials, no exceptions. Right. Just because you say the subsidiary is in a different business than mine, say the parent is a grocery store or selling FMCG, while the subsidiary is an insurance company, which is completely different. Just because you have different business activities, it's not an exemption to prepare consolidated financials. There's no such requirement as that. There is few exemptions, we'll go through that. But before that, let's delve a little bit on what do you mean by control, right? So what we mean by control is 3 things. You should have power over relevant activities. When you say power, the ability to direct, you should be able to tell how that activity should be conducted. You should not be threatened, or you should not be influenced by someone else's opinion. You should be able to make your decision on your own on how do you deal with a particular thing in the entity. So whenever you have power over relevant activities combined with exposure to variable returns and the ability to use the power to affect those returns. So what we mean by relevant activities is, so all these 3 has to be satisfied, right? All 3 together. 1, 2 and 3, all 3 conditions needs to be satisfied together. So ability to direct relevant activities. So the word relevant activities, what it means is the activities that significantly affects the returns of an entity. Now imagine a hotel operation, right? Imagine a hotel operation. So one party, say this S is a hotel, right? P acquires 60% in it. Say P acquires 40% in it, and another party acquires 60% in it. Now P, let's say, is a veteran, P is very experienced, P is running multiple other hotels. X is an investor who had money, who wanted to own a hotel but has no experience in running a hotel. So X agrees with P to say that, through a contractual agreement, agrees with P to say that, look here, you run all the activities relating to the hotel operation, you manage it, everything is done, you should do it because you are the expert there. I will take care of managing the property and managing the building status, repairing it if there are any requirements, things like that, but the hotel operation will be run by you. Now in that case, right, in that case you need to see, okay, if you look at the shareholding alone, this guy has majority, but even though he has majority, through an agreement he has agreed with P to say that P can run the business as P wants. So then you need to ask, see what are the activities that are controlled by P and what are the activities that are controlled by X. Then you need to see, which of those activities becomes the relevant activity. When we say relevant activity, the activity that influences or affects significantly the returns of an entity. So in my example, P is the one who will run the hotel operation, like sourcing customers, providing all hospitality services, managing the customers, arranging everything to the customers. Everything is done by P, which will no doubt be the relevant activity. So in this example, even though P owns only 40%, P has the power over relevant activities of S. Then you need to see, okay, does P have exposure to variable returns? Now imagine P did not have any shareholding. P was the one who had the power to run the hotel. So P was like a managing agent. Now in that case, P will have the power to run the operation. P has the ability to run the hotel. But say P was getting a fixed fee. P was getting, say, 500 million per annum for running the hotel. Now even though they had power, P wouldn't have had variable returns. In that case, we would not say P has control. But if P had 40% share ownership, P had the power to run the operation and has 40% share ownership. So out of the profits the company make, P will be entitled to 40% of the profit. So if the hotel makes $1 billion profit, P is entitled to 400 million. If the hotel makes 10 million, P is entitled to 4 million. Now that is exposure to variable returns, and P should be able to use that power they have to affect the return. The more they manage it properly, the higher the return they generate. So there is a link between the power and the return they get. So in an example like that, even though P owns less than 50%, we could conclude to say P controls S, right? So most situations are determined based on shareholding. Whenever it's like this, it's a pretty straightforward decision. If there is no contractual arrangements, when there are no contractual arrangements, it's pretty straightforward. You just go with the shareholding. But when there is contractual arrangements, you need to see this. This is the most critical criteria to determine control. Once you determine to say, okay, this party controls the other party, then the party who has control has to prepare consolidated financial statements, right? So that's why this control becomes so important. The definition of control and evaluation of control becomes so important, because the party who has control over the other party is the one who should prepare consolidated financials. All right? Okay. Then coming into in all instances you should prepare consolidated financials, but there are certain exceptions to do that, right? Let's run through that. So what it means here is, if let's say in the example that we took, P owns 60% in S. If this is the case, this is it, there is nothing more, no one else owns P, right? No one else owns P, then P has to prepare consolidated financials. There is no exceptions, regardless of what business P is in, what business S is in. However, if P by itself is a fully owned subsidiary of another organization, the parent itself is a fully owned subsidiary, right? We'll come to this part later, right? So the parent itself is a fully owned subsidiary. Parent is not listed, it's not a PLC, it's not listed, nor in the process of being listed. When you say not listed, either debt instruments or equity instruments, both of it. So it's not listed, it's not publicly traded, and this entity, the ultimate parent, which we refer to as the ultimate parent, this entity prepares financials combining X, P and S. So if all those three criteria are satisfied, parent itself is a fully owned subsidiary, parent is not listed nor in the process of being listed, and the ultimate parent prepares consolidated financials. In such an instance, P need not prepare consolidated financials combining its subsidiary. This level of consolidation is not required, since X will be combining all three. However, in that same example, in the same structure, if P Limited was a listed organization, public listed company, in that case, even though P is a 100% owned subsidiary, P still should prepare consolidated financials combining its own subsidiary. So all three conditions has to be satisfied together. And also say P is a limited entity or it's not a listed entity, and for whatever reason X is not preparing consolidated financials, or X is located in a country which is not preparing financials in line with SLFRSs or IFRSs to that matter. So if X is preparing financials not in line with IFRSs or SLFRSs, then even though P is not a listed entity, even though P is a fully owned subsidiary of someone else, P has to prepare consolidated financials. So the point I am making is, all three conditions has to be satisfied together, even if one is not satisfied, right? So you see, P is a fully owned subsidiary, this is okay. Parent is not listed, that is also okay. And the ultimate parent not preparing financials, then this criteria is not satisfied, then P has to prepare financials. In the same note, again, say P owns 70% of S and P is 80% owned by X. So we are moving on to this part where the parent itself is a partially owned subsidiary. So parent is a partially owned subsidiary. So that means there's other shareholders. Now, in that case again, if parent is not a listed entity and if X prepares financials combining X, P and S, in addition to those not listed, ultimate parent prepares financials, in addition to those, these other shareholders, they have to agree for P not preparing consolidated financials. Why? Because these shareholders might want to know what's the performance of this group, because they are shareholders of this group. They has nothing to do with X. So just because X prepares financials combining all three, they might not be interested in that. So they have to agree for P not preparing consolidated financials at this level, in addition to P not being a listed entity and X preparing its consolidated financials. So even in this case, if P is a listed entity, then this actually is irrelevant. Since it's a listed entity, P has to prepare consolidated financials. So again, reiterating it, all three criteria has to be satisfied together. And of course, you'll understand both of these conditions will not exist together. That's why we have said or, right? Parent itself is either a fully owned subsidiary or a partially owned subsidiary. So parent can't be a fully owned and a partially owned subsidiary, obviously, right? So that's why we have used or here. Other than that, everything else is and. Criteria 1, criteria 2, criteria 3. All three has to be satisfied together. Right. So we understood why or when you have to prepare consolidated financials, that's when you have control over an entity. Then we understood or discussed what do you mean by control. Control is the power over relevant activities being the activities that significantly affects the returns of the entity, exposure to variable return, and power, a link between power and returns of the entity.